Well, joining us to discuss the bond market now is Stephen Nash, Head of Strategy at FIIG Securities. We still have with us Greg Goodsall from RBS. Stephen, good to have you with us today.
Thanks very much.
It does appear that bond investors are getting just a little bit nervous. We're seeing, obviously, the belief growing that governments and central banks are going to start really pulling the stimulus out of some of these economies. I mean, when you take the macro look, your broader view, what are you saying to your investors right now?
Well, at this stage, we think that growth expectations are quite fragile. The recent discussion about banking reforms has, I think, damaged perceptions quite a bit. I think that's the thing that's really changed in the last few weeks for the RBA. So I think the case for tightening is there at this stage, but if the ongoing weakness in equity markets continues and revisions to growth are downwards, then the case for further tightenings might go away.
You were talking about the case for tightening in terms of Australia.
Yes.
With the RBA, because of course analysts are saying that Australia's bond market really stacks up quite well when you look at the global picture,
Yes.
Simply because our government isn't likely to be issuing quite as many bonds.
Well, our issuance will increase quite substantially from what it has been, which is probably it's a real positive for our market, because in the past supply was quite small, quantity of bonds was small, so global investors really wouldn't look at the Australian market. But now the issuance volumes are going up substantially. We're going to get a much greater interest in the Australian market, and I think the credit is unquestioned.
Stephen, in the US, it looks inevitable the level of issuance has got to increase. I mean,
yes.
the recent auctions have been very well received, but just looking at any of the sort of projections for GDP, for fiscal expenditure, they've got to increase. How do you think the market will respond to that?
I think, if you look at from 2008 to 2014, the projections, I think debt to GDP for the advanced 25 countries is going from about 50 to about 80%. Now, that's very sensitive to growth. So I think the problem for a lot of these economies will be if growth slips. If growth slips, obviously GDP goes down and the need to fiscally stimulate will increase. So those levels could go over 100% quite quickly. So I think growth is really key for these economies right now.
I found this interesting, actually. You're talking about these concerns that are in the market. We're seeing these sovereign debt concerns that we've mentioned briefly in the show today, really weighing on sentiment here. In fact, one I found was interesting. There was a survey done by RBS, in fact, at Davos, which showed that more than half the audience said their top concern was sovereign debt. I mean, how much of these really are new issues?
Well, I think the problems for these countries that are indebted, for example, Greece, well, if we get another dip in growth, will really come to the fore. So I think every time you get a weakness in stock markets, as we've got recently, you get a problem, an extra problem with Greek debt, as we've seen recently. So I think the problem will be exacerbated with lower growth. So talk of tightenings might be a bit preemptive, I think, at this stage, particularly in the US. Yeah.
I mean, one of the ways that it's probably not the best way. One of the ways that the US government could deal with its growing debt problem is to inflate the economy a bit and inflate its way out of the debt problem, which is actually we see bond yields going up. Do you see that sort of a scenario playing out at all?
At this stage, I'd say that the problem for the US, rather than inflation, is deflation, and they've got a lot of overhang in the labour market and product markets. So I don't think that's really a scenario at this stage. I think they've got a big funding task, but I think they can get through it at this stage. The problem will be if growth slips again, we get a double dip. If we get a double dip, then things could change quite quickly, but at this stage, we're not going for that. Yeah.
Not expecting that. All right. Stephen, wonderful to see you. Good to have you with us. Thank you for joining us. Stephen Nash from FIIG Securities.